When one spouse dies, half the household does not disappear. The property tax is still due. The roof is still the same size. The insurance, utilities, and most of the grocery bill keep arriving. But one Social Security payment may disappear. A pension may shrink or stop. The surviving spouse may move from married tax brackets to single ones. A retirement that felt comfortable for two people can suddenly feel tight for one, even when nobody was overspending. The danger is not simply grief. It is a financial plan built for two people that was never tested for one. The protection is a four-part survivor test: income, taxes, housing, and access. Run those four parts now, in both directions, and you can see whether either spouse could keep the retirement functioning alone. Start with income. For many retired couples, the first shock is Social Security. 2 monthly payments do not normally continue after one spouse dies. If the survivor qualifies for both a benefit based on their own work and a survivor benefit, Social Security generally pays the better amount. The two full benefits are not added together. That means the household often keeps the larger benefit and loses the smaller one. If the surviving spouse has not started benefits yet, the timing rules can be different from ordinary retirement benefits. Survivor benefits may be available as early as age 60, with a reduced amount before survivor full retirement age. In some cases, a widow or widower can claim one type of benefit first and switch to the other later when it becomes larger. That flexibility is valuable, but it is also easy to miss if nobody asks Social Security to compare the choices. Suppose a couple receives $6,000 each month from Social Security, a pension, and portfolio withdrawals. Their spending is $5,000. They appear to have a comfortable $1,000 cushion. Now imagine one $2,000 Social Security payment disappears. Household spending may fall, but not by $2,000. If expenses decline by only $700, the survivor now has a monthly deficit of $300 instead of a surplus of $1,000. Nothing dramatic happened to the house or lifestyle. One check simply vanished faster than the bills did. Pensions require an even closer look. Some pension elections provide income only for the participant's life. Others continue a percentage to the surviving spouse. A married participant covered by the usual federal protections generally receives information about a joint and survivor option, and waiving that protection typically requires the spouse's written consent. But the only answer that matters is the election actually made on your plan. Find the pension statement. Look for the survivor percentage, the monthly amount after either spouse dies, and whether any temporary supplement ends at a particular age. Do not assume that because the pension check arrives in a joint household, it belongs equally to both lives. Then list every other income source. An annuity may continue, reduce, or stop, depending on its contract. Rental income may remain, but become harder for one person to manage. Part-time work may disappear if the surviving spouse was not the one doing it. Life insurance may create temporary cash, but a one-time payment is not the same as permanent monthly income. Retirement accounts usually do not vanish when a spouse dies. A surviving spouse may have choices that include keeping an inherited account or rolling eligible assets into an account in their own name. Those choices can affect taxes and required withdrawals, so this is not a decision to make hurriedly during the first week of grief. The first survivor question is simple: which income continues, which income changes, and which income stops? Put the answer on one page. Show the current household income in one column and the survivor income in the next. Use monthly after-tax amounts where possible. A complicated plan becomes much easier to understand when the surviving spouse can see the exact gap instead of hearing that everything should probably be fine. Next, test the expenses. People often assume one person will need roughly half as much money as two. Real households do not behave that neatly. Food may decline. One Medicare premium and one personal insurance policy may disappear. There may be less travel and fewer vehicle costs, but property taxes do not become single. Homeowners insurance does not become single. The furnace does not heat only one side of the house. Internet, lawn care, roof repairs, security, and basic utilities remain attached to the property, not the number of people sitting inside it. This is why the surviving spouse can experience a lower income and a higher cost per person at the same time. Build a survivor budget while both spouses are alive. Start with the last 12 months of actual spending. Remove costs that truly disappear. Reduce costs that realistically decline. Leave the fixed household expenses alone. Then run the budget twice. In the first version, assume spouse A dies first. Use the Social Security, pension, insurance, and account rules that would apply to spouse B. In the second version, reverse it. The two answers may not be identical. One spouse may own the pension. One may have the larger Social Security record. One may manage a rental property or small business. One may need more paid help to maintain the home. A couple does not have one survivor plan, it has two. Now look at taxes. In the year a spouse dies, the survivor may generally still be able to file a joint federal return if the normal requirements are met. After that, many older survivors without a dependent child move to single filing status. The income may fall, but the tax brackets and standard deduction also change. The survivor can end up paying a higher effective tax rate on income that did not fall nearly as much as the household's filing advantages did. Required withdrawals, pension income, Social Security taxation, and realized investment gains may now land on one tax return instead of a joint one. This is sometimes called the widow's tax penalty, although the exact result depends on the household. Medicare can create another surprise. Income-related Medicare surcharges use tax return information, normally from 2 years earlier, and the thresholds differ between joint and individual filers. If a spouse's death reduces household income, Social Security treats that death as a life-changing event and allows a request to lower the income-related adjustment rather than waiting for old tax data to catch up. That request is not automatic. The practical move is to schedule a tax review after the first urgent tasks are handled. Estimate the survivor's filing status, taxable income, required withdrawals, and Medicare premiums before making large Roth conversions, investment sales, or inherited account decisions. Next comes the house. The family home is often the largest asset and the largest fixed expense. It is also where grief and money become difficult to separate. Selling immediately can be a mistake. The survivor may be making a permanent decision during the most disorienting months of life. But declaring that the home can never be sold can also trap one person inside a property designed, maintained, and financed for two. Calculate 3 numbers before the decision becomes urgent. First, the true annual cost of staying. Taxes, insurance, utilities, maintenance, lawn care, repairs, and any mortgage or association fee. Second, the cost of simplifying, a smaller home, condominium, rental, senior community, or location closer to family. Third, the realistic net proceeds after selling, moving, repairs, commissions, and taxes that may apply. The question is not whether the survivor can physically remain in the home next month. It is whether the home still supports the next 10 years of retirement. Housing also affects time and capability. The spouse who handled repairs, driving, paperwork, or caregiving may be the one who dies first. The surviving spouse may need to purchase services the couple previously provided for each other without writing a check. That is a real retirement expense. Put it in the plan. The final part is access. A surviving spouse can inherit enough money and still experience a financial emergency because they cannot find it, transfer it, or understand how the household was being run. Being named as a beneficiary is not the same as knowing which company holds the account. Being a joint owner is not the same as knowing which bills are automatic. Having a will is not the same as having immediate cash available while the estate is being handled. Create one survivor file. It should identify every bank, retirement account, pension, insurance policy, debt, property document, advisor, attorney, and recurring bill. Include current beneficiary designations, the selected pension survivor option, and clear instructions for accessing digital records through lawful estate planning methods. Each spouse should know how one normal month works. Which account receives income? Which account pays the credit card? When are taxes and insurance due? Where are the deeds, titles, and original legal documents? Who should be called first? Do not build a system where one spouse is the chief financial officer and the other is a permanent guest. Once a year, hold a survivor meeting. It does not need to be grim. Review the 4 parts: income, taxes, housing, and access. Ask which check disappears. Estimate the survivor's real monthly spending. Confirm the pension election and beneficiaries. Review whether the home still works for one person. Make sure both spouses can locate and explain the accounts. Then ask the most important question. Would the survivor need to make a major financial decision immediately? If the answer is yes, strengthen the cash reserve, simplify the accounts, clarify the insurance, or create a written housing plan. Grief should not come with a 30-day deadline to sell investments or leave the home. Keep enough accessible cash for several months of essential bills. Benefits, insurance claims, account transfers, and estate paperwork can take time. The survivor should not be forced to put groceries on a credit card because most of the household wealth is temporarily difficult to reach. A strong retirement plan is not only designed to last until both spouses die, it is designed to remain livable after the first one does. In the comments, tell me which part would change most in your household: income, taxes, housing, or simply knowing where everything is. 2 people build the retirement. The plan should protect either one who has to finish it alone.